Interest rates stand as a cornerstone of modern macroeconomic theory. They represent a critical factor that profoundly influences the ebb and flow of business cycles. Understanding their mechanics is essential for comprehending economic dynamics. At its core, an interest rate is simply the cost of borrowing money or the return on lending it. It is the price paid for the use of capital over a specific period. This seemingly simple concept holds immense power. Interest rates serve as a powerful lever for central banks and governments worldwide. They are a primary tool in monetary policy, used to steer national economies. Their adjustments ripple through every sector. Central banks strategically manipulate interest rates to manage key economic indicators. These include fostering sustainable economic growth and controlling inflationary pressures. They also aim to maintain high levels of employment. The implications of interest rate changes are vital for a diverse range of stakeholders. Investors constantly monitor them to guide their portfolio decisions. Businesses rely on them for financing expansion and operations. Individuals, too, are directly affected by interest rates in their daily lives. From mortgage payments to savings returns, these rates shape personal financial landscapes. Their influence is pervasive and undeniable. A fundamental principle governs the relationship between interest rates and economic activity. This principle describes an inverse correlation between the two. When one moves up, the other tends to move down. Specifically, higher interest rates generally tend to slow down overall economic activity. They make borrowing more expensive, which discourages spending and investment. This can lead to a contraction in growth. Conversely, lower interest rates typically tend to stimulate economic activity. They reduce the cost of borrowing, encouraging both consumers and businesses to spend and invest more. This fuels expansion. This direct impact on the cost of borrowing is central to their influence. It affects every entity that seeks capital for any purpose. The price of money dictates economic behavior. For businesses, borrowing costs directly influence investment decisions and operational expenses. For consumers, these rates determine the affordability of major purchases. This includes homes and automobiles. The sensitivity of economic agents to these costs drives the inverse relationship. Their reactions collectively shape the broader economic landscape. It is a constant push and pull. When interest rates are high, borrowing money becomes significantly more expensive. This increased cost acts as a deterrent for both individuals and corporations. It shifts economic incentives. Businesses face higher costs for financing new projects and expanding operations. The return on investment for potential ventures must now exceed a higher hurdle rate. This makes fewer projects viable. Consequently, companies become less likely to invest in new equipment or technology. They also become less inclined to build new facilities or enter new markets. Growth initiatives are curtailed. The increased cost of financing also impacts existing business activities. Debt servicing becomes more burdensome, potentially reducing profits and available capital for reinvestment. This can lead to operational adjustments. Furthermore, businesses may become less likely to hire new employees. Expansion plans are put on hold, and existing workforce levels might be maintained or even reduced. Job creation slows. For consumers, high interest rates make taking out loans for big-ticket items less attractive. Mortgages become more expensive, leading to fewer home purchases and a cooling housing market. Car loans also see higher payments. This directly leads to reduced overall consumer spending. People are less willing to incur debt for discretionary purchases. They prioritize saving or paying down existing, more expensive debt. The cumulative effect of these individual and corporate decisions is a decrease in investment across the economy. Capital formation slows down significantly. This impacts future productive capacity. Simultaneously, there is a noticeable decrease in consumption. Households tighten their belts and demand for goods and services softens. This creates a challenging environment for businesses. These combined factors inevitably lead to slower economic growth. The pace of expansion decelerates, and in some cases, the economy may even contract. This is a deliberate consequence of monetary policy. A primary objective of raising interest rates is to curb inflation. By slowing down demand and economic activity, the upward pressure on prices is reduced. This helps stabilize the purchasing power of money. High interest rates can also strengthen a nation's currency. Foreign investors are attracted to higher returns on bonds and other financial instruments. This can make imports cheaper, but exports more expensive. However, the slowdown can also lead to increased unemployment. As businesses cut back on expansion and production, the need for labor diminishes. This is a difficult trade-off for policymakers. The impact is not uniform across all sectors. Interest-sensitive industries like real estate and automotive feel the effects most acutely. Other sectors may experience a delayed or less severe impact. Ultimately, high interest rates are a tool to cool an overheating economy. They aim to bring stability by moderating excessive demand and inflationary pressures. This comes at the cost of slower growth. When interest rates are low, borrowing money becomes significantly cheaper. This reduced cost acts as a powerful incentive for both individuals and corporations. It encourages economic activity. Businesses find it more affordable to finance new projects and expand their operations. The lower cost of capital makes a wider range of investments appear profitable. This stimulates growth. Consequently, companies are more incentivized to invest in new equipment, technology, and infrastructure. They are more likely to build new facilities and explore new markets. Expansion becomes attractive. The reduced cost of financing also boosts existing business activities. Debt servicing becomes less burdensome, freeing up capital for reinvestment, research, and development. This enhances competitiveness. Furthermore, businesses become more likely to hire new employees. Expansion plans are accelerated, and increased production demands a larger workforce. This leads to job creation and lower unemployment. For consumers, low interest rates make taking out loans for big-ticket items much more attractive. Mortgages become cheaper, leading to increased home purchases and a booming housing market. Car loans also see lower payments. This directly leads to increased overall consumer spending. People are more willing to incur debt for discretionary purchases. They feel more confident about their financial future and the affordability of credit. The cumulative effect of these individual and corporate decisions is an increase in investment across the economy. Capital formation accelerates significantly. This boosts future productive capacity. Simultaneously, there is a noticeable increase in consumption. Households spend more, and demand for goods and services strengthens. This creates a favorable environment for businesses to thrive. These combined factors inevitably lead to increased economic activity. The pace of expansion accelerates, and the economy experiences robust growth. This is a deliberate consequence of monetary policy. A primary objective of lowering interest rates is to stimulate a sluggish economy. By boosting demand and economic activity, the risk of recession is reduced. This helps maintain economic stability. Low interest rates can also weaken a nation's currency. Foreign investors may find lower returns on bonds less attractive. This can make exports cheaper and imports more expensive, boosting domestic industries. However, the stimulation can also lead to increased inflation. As demand outstrips supply, prices begin to rise. This is a potential side effect that central banks must carefully monitor. The impact is not uniform across all sectors. Interest-sensitive industries like real estate and automotive benefit most acutely. Other sectors also experience positive spillover effects. Ultimately, low interest rates are a tool to invigorate a struggling economy. They aim to foster growth and employment by encouraging borrowing and spending. This comes with the risk of higher inflation. Central banks are the primary institutions responsible for adjusting interest rates. Institutions like the Federal Reserve in the United States or the European Central Bank wield this power. They are the guardians of monetary policy. Their overarching objectives are typically twofold: to manage inflation and to maintain stable economic growth. These goals often require a delicate balancing act. They aim for a sweet spot in the economy. During periods of rising inflation, central banks typically take decisive action. They raise interest rates to cool down the economy. This makes borrowing more expensive and discourages excessive spending. The aim is to bring prices under control by reducing aggregate demand. Higher rates make consumers and businesses less willing to spend. This eases inflationary pressures and stabilizes the currency's value. Conversely, during economic downturns or recessions, central banks adopt a different strategy. They lower interest rates significantly. This makes borrowing cheaper and more attractive. The goal is to stimulate borrowing, spending, and investment. Lower rates encourage businesses to expand and consumers to make purchases. This injects vitality back into the economy. This boost in economic activity is intended to create jobs and foster recovery. It provides a lifeline during periods of contraction. Central banks act as a crucial countercyclical force. Central banks also communicate their intentions and outlook to the public. This forward guidance helps manage expectations and influences market behavior. Transparency is key to their effectiveness. Their decisions are based on extensive economic data analysis and forecasting. They monitor indicators such as inflation rates, employment figures, and GDP growth. This informs their policy adjustments. The independence of central banks is often considered vital for their effectiveness. It allows them to make decisions based on economic necessity rather than short-term political pressures. This ensures long-term stability. While the inverse relationship between interest rates and economic activity is fundamental, it is not always straightforward. Several complicating factors can influence or even obscure this dynamic. The economy is a complex system. One significant factor is the level of consumer confidence. Even with low interest rates, if consumers are pessimistic about the future, they may choose to save rather than spend. Fear can override incentives. Similarly, business confidence plays a crucial role. If companies foresee weak demand or political instability, they may delay investment despite cheap borrowing costs. Uncertainty can stifle growth. The overall health of the global economy also exerts considerable influence. A strong global economy can mitigate the effects of high domestic rates. Conversely, a global downturn can worsen a domestic slowdown. The effectiveness of monetary policy transmission mechanisms can also vary. These mechanisms describe how interest rate changes translate into real economic activity. Their efficiency is not constant. For instance, if banks are reluctant to lend, even low central bank rates may not reach consumers and businesses effectively. Credit availability is as important as its cost. This can create a bottleneck. A significant limitation is the concept of the zero lower bound. This refers to the point where interest rates approach zero. Central banks cannot lower them much further. Extremely low interest rates can limit the effectiveness of monetary policy during severe crises. Once rates hit zero, traditional tools become less potent. This necessitates unconventional measures. Such measures might include quantitative easing, where central banks buy assets to inject liquidity directly. These are often deployed when conventional rate cuts are no longer sufficient. Furthermore, the impact of interest rate changes can have a time lag. It can take several months or even longer for the full effects of a rate hike or cut to be felt throughout the economy. Patience is required. Expectations about future interest rate movements also play a role. If markets anticipate further rate changes, they may adjust behavior preemptively. This can influence current economic conditions. The relationship is dynamic and influenced by a multitude of variables. Policymakers must constantly assess these factors to make informed decisions. There is no one-size-fits-all solution. The relationship between interest rates and economic activity is a fundamental concept in economics. It underpins much of our understanding of how economies function and evolve. Its importance cannot be overstated. Grasping this dynamic is crucial for navigating the complexities of the financial landscape. It empowers individuals, businesses, and policymakers to make more informed decisions. Knowledge is power in economics. For investors, understanding interest rate trends helps in asset allocation and risk management. It influences bond prices, stock valuations, and currency movements. Strategic planning depends on it. For businesses, it guides decisions on investment, expansion, and financing. Knowing when borrowing is cheap or expensive can significantly impact profitability and growth trajectories. It shapes corporate strategy. For individuals, it affects mortgage rates, loan costs, and savings returns. This knowledge enables better personal financial planning and budgeting. It impacts household wealth and spending power. For central banks and governments, it is the primary tool for macroeconomic management. They use it to steer the economy towards stability, growth, and full employment. It is their most potent lever. The intricate dance between the cost of money and the pace of economic life is a constant feature of modern economies. Its study offers profound insights into the forces that shape our financial world. By appreciating this core relationship, we gain a deeper understanding of economic cycles. We can better anticipate market movements and policy responses. This fosters greater economic literacy for all.